Hi everyone, Donna here with Bookkeeping Made Simple, and today I want to ask a really important question. How do you know if your books are right? Now, before I dig into this, please, as usual, if you enjoy this show, please like, share, and subscribe. You know the drill. Hit the red notification bell on YouTube so you get notified when new videos come up. And with that, let's go. The first question to find out is, are you on cash or accrual basis? There's a whole video I can do just on this, but basically, cash basis occurs when you receive cash for services right at the moment. For example, restaurants typically run on a cash basis. They get paid as soon as they feed you, and um, there's no need for them to carry accounts receivable. Um, Things like snow cone shacks. We're coming out of summer, so snow cone shacks will run on cash. There's no payables, there's no receivables if you're running on cash basis. Now, if you're running on accrual basis, which is considered the more accurate of the two, because in accrual basis, you earn your money as soon as you perform the service for which you are being paid. Um, and that can be kind of tricky because, for example, attorneys will accept a retainer before they ever perform any services, but they haven't earned that money yet. So it has to stay in a trust account. Attorneys, real estate agents, title companies, all of the same thing. Their money stays in a trust account until they've actually earned it. So even though their clients are paying them up front, they have not performed the service yet that allows them to recognize that income. So that on the other hand, construction companies often will bill after the work is done. So they will, if they're building a $1 million home, they're going to do progress invoicing, which means they're going to bill a little bit at a time. And they will recognize, again, that income as the money comes in. Not when the house is contracted for, but when it's complete is when all the money will come in, and they will recognize percentages of it. It's called progress building, a little bit at a time. So if you're using QuickBooks, it will say in the upper right corner of your reports whether it is on cash or accrual. If it is on accrual, you should be seeing accounts payable, accounts receivable, undeposited funds. What else should you be doing? Inventory. But you need to have that to be accrual. Very, very seldom do we like to see cash basis accounting. Again, whether or not we can run reports in either basis inside of QuickBooks. However, if you are using your QuickBooks to run your business, as you should, you need to know what basis is being used, and you need to know your payables, your receivables, and your inventory, if that applies. So that's number one. Most of these questions, by the way, are based on the balance sheet. Number two, there's no way this should be a question if you pull your reports from QuickBooks, but does your balance sheet balance? Way back in the olden days when dinosaurs still walked the earth, I took accounting in high school, and we had to do that the old-fashioned way in the 10-column ledger book. And that meant that we also had to create a balance sheet from sub-accounts inside of this ledger book. We couldn't just click it. Today, you click a button and QuickBooks generates the balance sheet for you. Back in the olden days, and this is, by the way, one of the reasons I like to use to have staff that understand accounting principles. They need to know this. We used to have to build those balance sheets by hand. And that meant we had to add up all of the accounts receivables and put those in the asset section. And we had to then figure out all of the assets. And those are usually pretty standard, and put them in the asset section. Then we had to take all the loans and credit cards, get their balances, put those in the liability section. And your asset should equal your liabilities plus your equity. If they don't, there's a mistake somewhere. However, with that said, there's no way QuickBooks is ever going to give you a balance sheet that's out of balance. There's no way. It just doesn't do that. It will add things into the equity section. And so if you have a balance sheet that's out of balance, there's a lot wrong. Okay? Now, I'm going to kind of come back to this because I am working on a balance sheet for a client right now. She's the sweetest thing. We just absolutely love her. But we're having to go back and redo about 5 years worth of work because her balance sheet is wrong. I mean, there's just no way about it. It's wrong to the tune of $1.2 million. So we are having to go back through and make sure that everything is absolutely to the penny correct, which is a lot of work because there's a lot of moving parts to bookkeeping. And there were a lot of things that were done in these books. And I've seen this multiple times. So I'm not singling out one single client. It's just that she brought it to mind. We see a lot of things like clients will learn to invoice in QuickBooks. We may even learn how to get paid in QuickBooks, but then they don't know how to group things together and create a deposit in QuickBooks, which I'm going to probably come to in just a minute. But that's a video for another day. I need to keep better track of my video ideas. Okay. So again, does your balance sheet balance? And if it doesn't, boy, there are some serious mistakes. You need to give us a call like right now. Do you have negative cash on your balance sheet? Honestly, there should be no negatives on your balance sheet. If you have a cash balance that's negative, that means your bank account's overdrawn, and that is no bueno. That is not good. No, 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 no. We do not ever want to see that. It has happened to some of my clients, but that's just not something we want to see. It gets very expensive to have an overdrawn bank account, and we want to make sure that that's not happening to you. So we want to make sure that you don't have anything overdrawn. Also, in the liability section of your balance sheet, none of those should be negative either. It is already accounted for inside of QuickBooks. If you set up your accounts right, QuickBooks knows that those are liabilities. They should still show as positive numbers. So if you're seeing negative numbers on your balance sheet and you're not closely working with the bookkeeper to get that fixed, that's a problem. Okay. These are, by the way, some of the things I go over to make sure that my clients' books are correct. So, inventory. I hate inventory. I hate it with a burning passion. However, if you are in the kind of company that requires inventory, that number should be changing every month. Your beginning balance from the first of the year should not be the same as your ending balance at the end of the year. Your beginning balance at the first of the month should not be the same as your ending balance at the end of the month. Inventory should actually be changing. And there's a lot that goes into that. That is a lot of cost of goods sold and work in progress, and a lot that goes into that most of my clients, it really doesn't apply to them. We have a few e-commerce clients who use a program called A2X for their accounting. A2X does sync up with Amazon, Shopify, Etsy, eBay, whichever e-commerce shop. I mentioned Shopify, whatever e-commerce platform that you're using, it can sync up to that, and it will actually pull in your inventory, cost of goods, work in progress, and put them in the right place. But still, we should be seeing that inventory number change. And we, as your accountants, should be able to go back through, have you do a physical inventory count, or have Amazon, Etsy, Shopify, whoever has your inventory, do that. And then match those up with your shipping receipts, with your shipping, with your sales, and come pretty close to the right number. Now, there's a number of different ways to account for inventory. There is FIFO, first in, first out. It is my preference because that's how I like to run my household. Use up your oldest stuff first and then use your new stuff. There's also LIFO, which is last in, first out. Then LIFO is what a lot of people use to begin with. What that means is, oh, by the way, you'll see this at the pump. If you're going to fill up your tank, you will be charged based on the replacement cost of the fuel that you're using. not what the service station purchased it for, because now they have to buy more. So they do price it based on replacement cost, which is why futures in petroleum are so important. But, and then there's, oh gosh, I've forgotten what it's called, but it is specifically tied to maybe specific assignment. I forget what it's called, but that is where inventory is based on, rather than first in, first out, it is, this is your car, and we are basing it on, gosh, I can't remember the name of it now because I never use it, because none of my clients do or sell anything that is so important or so large, except for maybe homes, that we ever use it. But it is, everything is specifically tied to this one product. This would be like a custom home, a custom car, not a mass-produced car, maybe a Rolls Royce. It would be specific jewelry, high-end stuff, things that are where we need to tie all the costs to that one particular piece, rather than most of the first in, first out, or last in, first out inventory methods relate to assembly line production. We will use specific assignment to tie them to a specific product. So a lot of times that's a home, that is a high-end car. It is very, very, very specific uses, typically homes. But again, your inventory number, if you have inventory, not all businesses do, but your inventory number should be changing frequently, at least once a month. Okay, another one that I see a lot on the balance sheet: payroll taxes. Are they negative? Are they positive? Are they insanely out of line? If you have a payroll that runs about $1,000 a week, and you look and you see that your payroll taxes are listed at $25,000, even though the number's positive, that's not right. Something is wrong. If you see negative numbers on your payroll tax account inside of QuickBooks, then that tells us one of two things. One, QuickBooks is not always perfectly accurate when it comes to figuring and paying payroll tax. So we either need to zero some things out, or you've overpaid your payroll tax. We can help you figure that out. Again, nothing on your balance sheet should be negative. Nothing. They should all be positive. If you are seeing negative numbers on your balance sheet, you do need to get some help to get that fixed. And yes, the balance sheet does make a big difference on all of your financials. Okay. Negative gross profit. On your profit and loss or income statement, we do call them both things, there is going to be a section for your total revenue. That is all of the money that comes into your business from sales. We may break that out a little bit, but typically we do them pretty broad categories. So in my case, for my particular business, I do have a separate category for how much money do I make doing taxes versus how much money do we make doing bookkeeping. But that's pretty easy to figure. Now, as part of the taxes, now I have to buy tax returns from my online tax return software, and I have to basically purchase the privilege of filing those returns electronically, and that costs me money, obviously. Okay, so I have to then look and make sure that so we'll have your revenue number, and then we'll have your cost of goods sold. Now, for my particular use case, I will have a revenue from tax returns minus how much did I have to pay to file those tax returns, because I do have to pay a fee. And then if that number is negative, then I have a problem. The problem is either I'm not charging enough for tax returns, which is a possibility, or I've got something miscategorized in my book. So we'll want to dig into that and find out what that problem is. Is that, did my regular QuickBooks subscription payment get attributed to income tax returns, or vice versa? But that is your gross profit, by the way, is your revenue less your cost of goods sold is your gross profit. We want that number to be positive because now we have to take expenses out of that. So if that's not right, then you need help with your books. Again, some companies may do this as like a loss leader. So they will bring people in and take a loss on certain products. They'll know that they're doing it, but that should be a very rare thing. So your gross profit, again, that's revenue less cost of goods sold, should be a pretty hefty number. Okay, you shouldn't have that much in cost of goods sold. Even if you're a manufacturer, you should know exactly how much you have in cost of goods sold at all times. And if you are not pricing high enough to actually earn a profit, then we have a problem. I've actually seen this with families who like to do a lot of crafts. They will literally spend $20 to make 10, and they don't track it. They just have no idea what they've spent on supplies to make, I don't know, Christmas ornaments or Halloween decorations or whatever that they're selling. But it will turn out that they spent way more in supplies than they did on their product, or for revenue for their product. And that is not a good business model. Okay, so another thing that always clues me in: rent expense, utility expense, telephone expense, things like that. These are the backbone of any business. Now, a lot of people will say, I don't want those in my books because I don't want to write them off for taxes. And I think that's a stupid thing to say. Sorry. We have to have them in your books because even if you're running your business out of your home, you need to rent part of your home to your business for an office space or for storage space or whatever you're using it for. In my case, I have a dedicated room in my home that is for an office space. And my business rents that from my boyfriend. And we do that on purpose. And we rent it for about market price. And that way, for one thing, I know if I move out of my home, if I decide to take my office into commercial office space, I already know what I can afford because I'm renting my office space. Okay, even if it's in my home. Now, you might not want to choose to do this. There's also the business use of a home, but I really prefer to actually rent the room to my business, so that I can have a rent expense in my books, so that then I know what should be about average, so that when I go to rent an office space, if I ever decide to go that way, and I've been working from home for 20 years, if I ever decide to go that way, I can easily figure out what my budget is for rent because I've already budgeted it. Okay. But if you have expenses that you know that you pay every month, and again, the big ones, the ones that always make my eyes pop, rent expense. And by the way, if I am doing your taxes and we've been doing your books, and I see no rent expense, no phone expense, no utilities expense, I will impute them to you because it is normal and ordinary and expected that you're going to have these kind of expenses. Same thing for insurance. Now, I pay my insurance annually, so I don't have to make those payments over time, but that should be put in an account called prepaid insurance, and then it should be expensed over the length of the policy. There's a number of ways of doing that, but that is how it should be treated, and that is so that we can see over time. We want to see what your consistent fixed expenses are, so that as you grow, it makes it easier to budget and forecast for it. Okay, again, this is something that should never, ever be seen inside of QuickBooks, and that is if you look at your profit and loss, and you look at your balance sheet for the same date span. Okay, so let's say we do all of 2022. Let's say we do, well, this is September. Oh, I forgot to switch my calendar over. I need to do that. This is September 6th. So let's say we just look at January 1st to August 31st. If I pull up your profit and loss and your balance sheet, there's going to be a number at the bottom of both of them. On your profit and loss, it's going to say net income. That net income number should match retained earnings on your balance sheet. If they don't match, someone's been mucking around in your books and doing things they shouldn't be doing. And we need to find it and fix it. But however, with that said, QuickBooks automates so much of this that there's no way you should ever be able to pull reports with two different numbers for net income and retained earnings for the same time period. So probably if that's happening, you're probably pulling the wrong dates because, again, it's just not something it's possible to do inside of QuickBooks. Accounts receivables, accounts payable. Do you know what they are? Yeah, this is another number that throws things off. A few big red flags on the balance sheet. If your undeposited funds is really high, and we can go back and see, it will be in the bank deposit window. We can go back and see how far back. Like I said, I've had clients that have accepted payment, it went into undeposited funds, and then they didn't know what to do with it from there. So then when they accepted the bank feeds, they just accepted it as a deposit, and that double dated their income extensively, like by twice. So we want to make sure, one, if your undeposited funds is an unreasonably high amount, that's a red flag. If you are telling me, yeah, my accounts receivable is up to date, and I pull an accounts receivable report and I see things going back for years, that's going to tell me right off the bat, your financials are not right. Same thing with accounts payable. Now, to be fair, a lot of my clients don't do accounts payable really well. And it can be tough because we're all anxious to see the money coming in, but we're not anxious to see the money going out. So we're not really seeing accounts payable too often, but I do strongly recommend it because it does help a lot with the forecasting cash flow. But we want to make sure that those payables and those receivables are reasonable numbers for your business. And by that, I mean, if you have a $200,000 a year business and you have $1 million in receivables, I'm going to wonder. Same thing with payables. If you have a $250,000 a year business and you have $1 million in undeposited funds, even if you have $200,000 in undeposited funds, I'm going to call your books into question because that's just not reasonable, given the volume of business we should be expecting. So you want to double check and make sure your balance sheet is correct. Those are a few things to take a look at. It really only takes a few minutes. Like I said, if you look, you can scan your balance sheet really quick. You know your business, so you should know about what you're grossing. And you should be able to scan it really quickly and start to say, I have negative numbers on my balance sheet. I need someone to take a look at that. I have more in receivables than I made the entire year. That's a problem. And by the way, it's a problem on a lot of levels because cash really is the lifeblood of business. We need to see that cash in your bank account, not in your receivable. And with that, I'm going to go ahead and let you go. I'm going to do another video on the difference between cash basis and accrual basis, a little bit more in depth. And I will talk to you again really soon.